That's yeah, at this point, right? So true.
Hey, Ria, how was your India trip? You still jet lagged or no? Okay. Yeah. That's fine. That's, but you probably would fall asleep in the night class anyway, right? It has nothing to do with India, so. Yeah. Okay, folks. At the risk of pulling off scabs of wounds, your quizzes are upstairs waiting to be picked up, waiting and waiting and waiting. I will leave them out there till they become recycling. So it's in a sense, it's out of my room. I want it out of my room. But somewhere in the next 2 weeks, I will bring it in. So I will leave it out there for a while. And if you can't find your quiz, it's because somebody's been playing with the alphabetical. It was in perfect alphabetical order yesterday. It's not in imperfect alphabetical order anymore. I've already resorted it twice, and I'm done. So at this point, it is what it is. So, but remember, it's 10%. It can be a throwaway quiz if you did it badly. It can be a keep quiz if you did it well, but don't overplay it, right? So if you did well, great. If you did badly, it's okay. There's more to come. So today we're going to talk about the biggest number, somewhere after we talk a little bit more about growth, the biggest number in evaluation, which is your terminal value number. It's a number that if you don't pay attention to, can very quickly take over your valuation and drive it to ruin. All that work you put coming up with the earnings and the cash flows and the growth for the first 10 years, gone in a second. So today we're going to put what I call guardrails in terminal value. So you can decide what you can or cannot do. And there are a whole lot of things you cannot do once you get to the terminal value calculation. So I'm going to start that discussion today with a question that we're going to come back and talk about more. So you projected out cash flows the next 5, next 10 years, you get to year 10. Why do we have terminal value? Because we need closure. We can't estimate cash flows forever. You're trying to come up with a terminal value. Which of the following is never an appropriate choice to get terminal value, right? So 3 of the 4 obviously are okay. Is liquidation value okay for a terminal value? Franz, what do you think? You think so? Let's say you're valuing a business run by a 70-year-old plumber, right? And his son has moved on, works somewhere else. And his practice is kind of going to die with him. You project out the cash flows. First, you have to check the actuarial tables to see how long he lives, 10 years. And then at the end of year 10, what are you going to do? It's a special situation. Is it that special? There are 90 times more valuations of personal businesses than are public companies, right? In those businesses, liquidation value actually makes sense because or take Aramco, at the end of 50 years, you get all the oil out of the ground. How much is are the Saudi sands worth? Nothing, right? Okay. Liquidation value is a perfectly appropriate way of doing things. We don't do it with publicly traded companies not because there isn't a liquidation value, but because the going concern value might be higher than the liquidation value, right? Every business is a liquidation value. For some, the liquidation value might be higher. So that's okay. How about a stable growth model? That's what we do all the time, right? Isn't that the only way to get terminal value? Well, I mean, it's in some textbooks, it's presented as the only way. Can I get to year 10 and make it a growing annuity? You know what I mean by growing annuity? Rather than assume cash flows continue forever, I assume they continue for another 15 years. Think it's okay? Yeah. So tell me the kinds of companies we are more likely to take that path than the cash flows in perpetuity.
Companies that might have technology in the future that might.
In fact, you see the technology we're on right now, recording this class, Zoom. Great technology, but if you think we're going to be sitting around 60 years from now on Zoom, You have a very different perspective on this is a technology. It's a great technology. It too shall fade. You're valuing Zoom, you get to year 10, you're going to get this scaling up effect. And then there's no forever, 10, 15 years, and you're done. So that's okay. So I've kind of led you to the one thing you should never do, which 80% of banking valuations do all the time, which is you get to year 10. How do you get terminal value? You apply a multiple. Private equity, same thing. You think, what's wrong with it? There's nothing wrong with it. You made your biggest value in your intrinsic value into a forward pricing, right? This is a forward pricing dressed up to look like a discounted cash flow valuation. If we're going to have a forward pricing, let's have an honest discussion about the forward pricing. Don't give me this front end of a DCF model, fool me with cash flows and growth rates and discount rates for the next 10 years, when I know the biggest number using is 8 times EBITDA in year 10, which you got by looking at some peer group you invented. Why do you think bankers like exit multiples so much? Because they're pricers. The game is a pricing game. We're making them play this discounted cash flow story when in fact, hey, you're a banker. Just take the DCF out of there. Let's talk pricing. Let's do it right. So a lot of discounted cash flow valuations out there are really not discounted cash flow valuation. They're forward pricing with a front end of cash flows. Yes. Because I think we're all supposed to do it because, it's become this right of, hey, you are a deep person, you got to do DCF. Shallow people do pricing, so here's how I show I'm a deep person. I do cash flows, I do discount rates, I know what a free cash flow is. Your heart's not in it. And at the end of the process, you're working back to whatever you need to pay. I understand the incentives that drive you there, but think of how much time you spend on that cash flow front. The weeks you spend with sleepless nights trying to the free cash flow in year one, knowing fully well it doesn't really matter. Now let's make this about a perpetual growth model. Let's say you're looking at a business, it's already in stable growth. It's got 100 million in after-tax operating income, no growth in perpetuity, and a cost to capital of 10%. Ravi, what's the value of this business? Nikita, help out Ravi. So we have a cash flow, constant cash flow forever, discount rate of 10%.
Since we don't have a growth, just because.
Wait, do you not have a reinvestment number? What did I give you as a growth rate? 0%. How much do you need to reinvest to get 0% growth? 0%. This is one of the few cases we can actually take after-tax operating income and treat it as free cash flow. It's not that way. So basically, the zero growth means zero reinvestment. Your numerator is therefore 100 million. It's a free cash flow to the firm. Denominator is 10%. The value of this business is $1 billion. Everybody agree? This is the McKinsey model for terminal value, where you have no plat in the numerator and growth in the denominator. We'll talk about what McKinsey assumes to get you there, $1 billion. And you're not happy. Why are you not happy? You wanted a bigger number. So I'll give you a pathway. Let's suppose you put in a 2% growth rate into this story. What's going to happen to the terminal value? What? Yeah, I'm going to let Michael jump in. What do you think will happen, Michael?
Well, it's going to
Mathematically, it should go up, right? Because in the denominator now you have 10% minus 2%. What's in the numerator though? It can't be 100 million still, because to get to that 2% growth rate, what do you need to do? You need to reinvest. How much do you need to reinvest? Here's where the magic of sustainable growth kicks in, right? Because if your return on capital is 10%, you have to reinvest 20% of your after-tax operating income. How do you come up with the 20%? 2% divided by the 10%. Try this out. Take your numerator, take 20% off, divide by R minus C. Guess what your terminal value is going to do? Absolutely nothing. It's going to stay exactly the same. Why? Because your return on capital is equal to the cost of capital. It seems like magic when you earn exactly your cost of capital. If this were a capital budgeting project, what's your NPV going to be? 0. What happens if you take a project with an NPV 0? 0. What if it's 1,000 times 0? 0. Right? Growth becomes just running in place. So today we're going to, because people often talk about the growth rate and the terminal value being the big deal. You can already see that's not the real big deal. It's what you assume about excess returns in perpetuity. So we've already started to put some guardrails in on terminal value. We'll come back and talk about them. But I want to go back to where I left you on the growth discussion. I was in that long and very boring discussion of retention ratios times. I was bored. I don't know how you were not bored so I fully understand if you were bored as well. But in sustainable growth, we look at two questions. How much are you reinvesting? How well are you reinvesting? And we talked about growth in earnings per share, retention ratio times return equity. We then looked at growth in net income, where you looked at equity reinvestment rates instead of retention ratios, richer measure of how much you're reinvesting, and a non-cash return equity. Let's move one step up the ladder. You want to get a growth in operating income. You measure how much you reinvest with a reinvestment rate. What's a reinvestment rate? You take net capex and change in working capital with all the caveats of the things we count in there, right? R&D and acquisitions. And you divide it by after-tax operating income. Notice a pattern here. Whenever you're looking at equity, we focus on what percentage of net income you put back. Here we look at the percentage of after-tax operating income. And when we look at how well we invest, we look at return on invested capital. Our perspective is about the entire business. And again, the sustainable growth equation is your reinvestment rate times your return on capital is your expected growth rate. So I'll take you back in time. This is 1999. Cisco was on top of the world. Very similar to where NVIDIA is right now, right? The architecture of the internet. And it had phenomenal fundamentals. In fact, the reinvestment rate was 107%. Remember those acquisitions that Cisco did? Pushed up the reinvestment rate. But what was impressive is the return on capital they were delivering. Again, accounting numbers, to the degree I trust them, 34% return on capital. If you reinvest 107%, you have a 34% return on capital, your expected growth rate would be 36%. So sitting in 1999 looked eminently reasonable, right? One of the great companies of the 1990s. So what do? You projected these numbers for the next 10 years. What went wrong? Anybody? Yeah.
They can't keep doing it.
Well, they were already big, so the 106% reinvestment rate got more and more difficult. They tried to keep growing at that rate, but the return on capital very quickly started to drop back down from 36% down to 10%. Cisco did exactly what they did in the 1990s in the following decade, but with very different consequences. Instead of creating value, they were just running in place. Cisco's market cap in 2010 was roughly what it was in 2000. Same management team, same model for growing. And this is something we're going to come back and talk about with acquisitions. Acquisitions are almost a time decay strategy. They work, but there's a point in time where they stop working because you become too big to keep doing it. So underlying all these sustainable growth models is an accounting return, right? Return on equity, return on invested capital. And I think I've come across as skeptical about accounting numbers, and I'm using the word skeptical to understate what I really feel. It terrifies me every time I compute these numbers. It terrifies me even more when I hear consultants using these numbers to drive company decisions. Because I've been in the kitchen, and you don't want to see the return on invested capital made. If you're interested, I shouldn't say, if you have trouble sleeping at night, I think I have a solution. A paper I wrote on accounting returns, return equity, return invested capital, that was so incredibly boring, I fell asleep multiple times while I was writing the paper. So if you read this paper, 2 pages in, you're sleeping like a baby. I did this in Portugal. I couldn't go to sleep. I read my own paper, 3 pages in, jet lag gone. It's almost like my body said, I'd rather go to sleep than listen to you read me this crap. But here's what I did. I took that accounting return capital, which fundamentally looks like a simple equation, right? After-tax operating income divided by book value of debt plus book value of equity minus cash. Only place in finance, as I said, we hold on to book value. And then I started looking at all of the things accountants could do that could skew return on capital. Starting with 2 we've already talked about, leases and R&D. The main reason we capitalize leases and R&D is to get a better sense of invested capital and return on invested capital. When a company takes a restructuring charge, think of what they do to your invested capital. What happens to your invested capital right after the restructuring charge? It drops, right? So if I'm not aware you've done that and you computed return capital the next year, I'm going to end up with this really high return on capital for the company, thinking it's taking great projects when in fact it's been writing off its mistakes. So this entire paper, 64 pages, is about taking what accountants do and working it through, which effectively means to get the return on capital for last year for a company. I can't just take the accounting numbers, I've got to clean up for it. But at the end of the process, you can get an accounting return on capital. How much you trust it will probably vary across firms. If you have a firm that's primarily intangible in its investments, the return capital becomes shakier because you had to capitalize things, you had to bring them in. Older firms, return invested capital becomes less trustworthy because the older assets become, the less book value actually captures what you originally invested. So with all of those caveats, it's still true that the return on capital becomes this driver. And the return on capital we're talking about for the future is not the accounting return capital for the past, is what you think a company will make on its future projects. One final piece of the sustainable growth, and then we'll put it to sleep. Everything we've talked about so far is when you have a return on equity or capital that's stable, 12%. But if your return on capital changes, and we talked about this a little in the last session, you get this efficiency effect. I'll take a very simple example. Let's suppose you have a company with a return on capital of 10%. It reinvests nothing, but it doubles its return on capital next year. Diksha, what's its growth rate going to be next year if you go from 10% return on capital to 20% return on capital? 100%, right? You think that's amazing. But it's done. You get to 20%, unless you can go to 40 and then 80, you're kind of stuck. Efficiency growth basically means as you work your way towards that end game, you can get this efficiency growth adding on. This is why you can't use it in the terminal value calculation as a justification for growth, because you can't keep growing by just making yourself more efficient over time. So as you go through time, you are making assumptions on return on capital and margins. So take everything we've talked about so far, because I'm going to give you 5 companies, all of whom are growing at the same rate. And I want you to rank them in terms of the quality of growth. Quality in the sense, as an investor, which of these growth rates creates the most value and which one's the least? So you look across the 5 companies, they all have 10% growth, but they get there in very different ways. The first 3 firms get there with different combinations of reinvestment rate and return on capital. The last 2 get a supplementary growth from improving their return on capital. So if you're looking at the 10% growth rate, which one is a complete freebie growth here? Look at firm 5. All of the growth is efficiency growth, but it's just for 1 year. If you look at it in terms of present value, it's one and done, and then after the first year, you're going to go to 0% growth rate. But if you look at long-term growth, which of these firms do you rank most highly and why? Gabrielle? So you go, all of them grow at 10%. But when you grow, remember, we're also looking at how much you have to put back into the business to grow. So is it the reinvestment or the other half of the puzzle? Remember, it's return on capital times reinvestment rate gives you growth rate. Based on the reinvestment, you're right. The low reinvestment is what you want. It comes from having a really high return on capital. Firm 1 is clearly a winner. 10% growth, very little reinvestment. You can get 80% of your earnings as cash flow, still grow 10% a year. In contrast, look at firm 3. It's growing at 10%, but every time it grows at 10%, it actually makes itself less valuable because it's earning well below the cost of capital. So when you look at return on capital versus cost of capital, you're getting a very quick proxy on, is this company growing and creating value, which is what firm 1 is, doing nothing for value, which is firm 2, or destroying value in firm 3. Other than that. Yeah. In fact, I would rather firm 3 shrink, right? If you can get out of this business, all the more power to you. That's why I've said I've never understood airlines that tried to grow. I can understand that an airline that's stuck in place can't get out, but an airline that's growing, what universe are you in? What business are you looking at? I'm not seeing any of the numbers there. Company like Indigo, right? Fastest growing Indian airline, basically doubled its size. I don't know whether this is a disaster waiting to happen or whether they've found some new way in which they can earn more than the cost of capital long term. Maybe they have. Okay? So when you look at growth, that's basically the end game. So now let's talk about the most generic definition of growth, because I'll wager none of you in this class is going to be able to use a sustainable growth equation for the next 10 years, because things will be changing, margins, returns. So I'm going to look at the broadest possible way to think about free cash flows in the future. This is what my FCFF simple Ginzu spreadsheet is built on, but I want to take you input through input. So you sit down to value a company. If your margins are changing, you have no choice but to forecast revenue. Do you see why? Because your margins are changing. You can't do operating income. Too much stuff is happening. It's revenue growth. We're going to talk about what it is that will allow some of you to be able to use high revenue growth rates and others not to be able to get there. Then we're going to take a stop at margins, essentially the profitability of business. Again, some of you are going to be able to aspire for much higher margins than others. We'll talk about the economics of what drives us. And third, you got to reinvest to get that growth. And because the growth is in revenues, I'm going to tie the reinvestment to the change in revenues. I'm going to use a very simplistic ratio, what I call sales to capital. It's like the return invested capital, but I'm looking at revenue to invested capital to see how much revenue I get per dollar of capital invested. Those are the three big numbers that drive every valuation. Let's look at what are the factors that will allow you to kind of give companies different numbers. So I want somebody who wants to take that. In fact, you can get started in your valuation. You haven't done it. Tell me what your company is, and we'll use the framework to think about, can we give this company high growth, low growth? Anybody want to be the guinea pig? Okay. Who are you doing? On. Okay. On is a great example. On, of course, makes, it's a niche footwear company. So first stop is revenue growth. There are two numbers I need. I need to get a sense of the total market and what share of the market my company will get. It'd be nice if the total market itself is growing, right? Because that gives me more room to grow. First, what's the total market that On is going after? Footwear market, perhaps a subset of it, athletic footwear, because they're not obviously competing against Rockport or one of those. So footwear company. Is it a big market? It's a pretty big market. In fact, if you wanted to estimate how big that market is, what's the way you're going to do it? Look at the revenues, because most of the companies, Nike, Reebok, Adidas, are publicly traded. You add up the revenues, and you're going to get a market that's large. 250 billion, 300 billion, 400 billion. How big is On's revenues right now? 800 million. So already you can see if you have a company that has revenues of less than $1 billion, the market is 400 billion, you have a lot of room. I'm not suggesting it's guaranteed that you can grow, but if you put in a 20% growth rate, then you know what? Market's big enough. Let's say you're valuing Volkswagen. What's the automobile market look like? It's big, but it's mature, right? In fact, if you think of it as gas-powered automobiles, it's probably going to shrink because electric cars are going to take away more of their market. Volkswagen already has the largest or the second largest market share of the market. So it's a large portion of a stable, mature market. You give a 20% growth rate for Volkswagen, I have some questions, right? Because that basically means you're wiping out Toyota, you're wiping out BMW, and I don't see a universe where that is going to be sustainable. So you're looking at the total market, you're looking at the growth in the market. You're also looking at your market share. And if your market share is big, you already start. So let's take a company like NVIDIA. Let's take the AI chip market. I'll give you the bad news first. The bad news for NVIDIA is they already have an 80% market share of the market. What's the good news? The chip market is growing 40, 50% a year. So even if their market share goes from 80 to 60%, their revenues are going to grow at 25, 30, 35% a year. So when you're looking at your company, you're looking at the total market, you look at how fast it's growing and what share of the market is, and you're making your best judgment. To make that judgment, you also have to factor in who you're competing against, right? If you take On, who's their competition? Nike, it could be Reebok, it could be let's face it, there are other niche companies entering this space as well, right? Because they see what On has done, say, we too can do this. So this is a competitive market, and what sets companies apart in this market? What sets companies apart? Brand name, right? So you're already thinking about what kind of brand name it's on, how many people recognize it, how sustainable is this brand name? Is it going to be like Croc, the source, and then kind of loses brand name and tries to come back? It's a fad-driven business. There are very few companies that have had brand names that have lasted. The reason we talk about Nike and Reebok and Adidas is they're the long-lasting ones. So you're looking at the market, you're looking at the market share, looking at the competition. You see, that's a lot of things to look at. It is the world we live in, right? To value a company, you have to know what your company does. Any questions on revenue growth? For any of you, have you picked a company where looking forward, you might actually see negative revenue growth? What kind of, give me an example of a company where looking at the market and the market share.
Gig-based economy,
What?
a gig-based economy.
A gig-based economy. That's a little too much for me to wrap my head around. But I'll give you an example. Let's say, well, anybody valuing Altria? Philip Morris? Right? Tobacco company. Dominates its market, biggest market share, but the market itself is shrinking. I'm going to expect to see a negative revenue growth rate. If you put in a positive one, you need a story, right? What's the story? They're entering the vaping business. They're entering the cannabis. In fact, the big question is, what's the biggest advantage tobacco companies have is they know how to live in a world where everybody hates them. And essentially, they found a way to survive and prosper and deliver profits. And the big cannabis company has to have those characteristics as well, because it's only a matter of time before we discover cannabis destroys your brain cells and people start suing. Yeah, tobacco companies, I've seen this movie before. Okay. So if you give me a positive growth rate, you have to tell me what other markets are entering. So that's first stop. Second stop, as we do this, I'm going to take an example. Airbnb went public. You know when it went public? Most unusual IPO ever. November of 2020. The world was still partially shut down from COVID. You have a hospitality company. And I think it actually made sense to them to do it because their competition had been hammered so much more by COVID that their differential advantage was greatest. So at that time, I did a valuation of Airbnb and I ran into a problem. What's the total market for Airbnb? It's hotel business, right? Anybody traveling and renting a room. And in 2019, collectively, hotel companies had revenues of about 700 billion. It was a very consolidated market, the big names, Hilton. So it's a business that's about 700 billion, has about 4 or 5 big names, and Airbnb's entering. So when Airbnb filed its prospectus, the people behind the company, the founders, the owners, the VCs, part of writing the prospectus said, estimated that their total addressable market, and Silicon Valley has become very clever about this total addressable market, serviceable addressable market, essentially a big number, 1.8 trillion. Already that gives you pause, right? Hotels are 700 billion collectively around the world. You're telling me that there's going to be 1.8 trillion. And then they went further, that if you add in experiences, remember there was talk at Airbnb that hosts would add experiences, and you went to San Diego and you rented one, your host would arrange all the nice locations nearby. Never quite bought into that notion of I trust an Airbnb host to also be my city guide. But they said if you add that on, it's $3.2 trillion. First, when you look at these total addressable markets, Uber, when they went public, estimated their total addressable market to be $5.2 trillion. You know how they got there? They added every dollar people spent, not just on car service, but in buying automobiles, on public transit. They basically took anything that anybody spent on transportation, threw it in there. Why do you think VCs and companies want to throw this big number out there? Because when you think about growth, you think about, hey, Uber's only at 100 billion. It could be 5.2. So there's a little gaming going on. Clearly, there is zero chance that Airbnb's potential market is 3.2 trillion. But I do believe that it'll be greater than 700 billion. Why? Because there will be people who travel to other places who would not have in the old hotel business, but might now do it with Airbnb. Because you can take a family, stay in a 3-bedroom apartment, basically not pay what you do in a hotel. So when I valued Airbnb, I did assume a market potential that was greater than 700 billion, but well below that total addressable market. But you can see with young companies how this becomes often the starting point. What's the market I'm going after? Second stop, oh, one more thing on market share. This is actually something you saw in almost every Silicon Valley sales pitch. It's the flywheel effect. What it basically is an illustration of how as you get bigger, it gets easier for you to get bigger. You see this with Uber, you saw with Airbnb. Here's how the Airbnb flywheel worked, right? You want to list your apartment on a service. Where do you list it? You list on the service that most people go to. So Airbnb, if it becomes the biggest, will end up kind of pushing others up. If you want to rent an apartment, where do you go? You go where everybody else is. It's the same phenomenon with rideshare. What that effectively means is the end game here, and this might depress people, is you won't have 15 different platforms. You're going to consolidate into 2 or 3. It's already happened in the US. There are only 3 places you can go to rent apartments: Airbnb, Expedia, and VRBO, and Expedia owns VRBO. So you basically have 2 places to go. And that's, in a sense, the problem with these platform-based businesses is competition is essentially going to get demolished, and you're going to end up with winner take all, which means when you value these businesses, you can also give them a much higher market share from a valuation perspective. So revenues, market share, you're already thinking about business economics, size of the market, and making those judgments. So let's say you've made those judgments. So with On, they might decide to give them 30% growth because they have a strong brand name, it's a niche business, it's going to grow. Now comes the second stop. You have to estimate what they will make as margins. And again, let's go back to basic economics. The biggest single driver of whether you can have high margins or low margins is unit economics, something I've talked about off and on through this class. What do unit economics measure? They measure how much you make on that next unit you sell. If you have great unit economics, you're going to have high operating margins. If you have terrible unit economics, you can never escape from that. Now you take a software company. You know why we can give them 45, 50% margins? Because the unit economics are just amazing, right? The next unit you sell costs you almost nothing. Why does NVIDIA have so much higher gross margins than everybody else in the business? Because they don't make the chips. They design the chips that are essentially almost like a software company. They do the design, TSMC makes it, they price it higher. So you're looking at unit economics in your company and saying, hey, good unit. If you're a manufacturing company, I don't care how good you are, you're never going to get to 40, 50, 60% margins. You're going to be shooting at 12, 14, 15% margins. Second stop, economies of scale. Every company I ever talked to talks the economies of scale. They're going to be economies of scale, right? But how do you separate the wannabes from the ones that actually have what could you look at in the data that would tell you whether a company truly has economies of scale? Jacob, what do you think?
There's a big company in that same, that operates
Yeah.
in the same business and
So you're looking at cross section. Is there something in the cross time comparison that will tell? What's the definition of economies of scale? That costs are growing at a lower rate than revenues, right? So if I gave you 10 years of financials on my company, my revenues grow at 11% a year, my costs are also growing at 11% a year, I have no business talking about economies of scale. The best giveaway in economies of scale is look at revenue growth over time, look at costs over time. And if you have economies of scale, what does it mean? When you project margins for this company, as they get bigger, there'll be this upward pressure on margins. So unit economics, economies of scale. So let's say you have economies of scale. You're cutting costs down, right? This is good for your margins. But before you make that judgment, what's a wild card? If you have 3 competitors who are also scaling up, they're also reducing costs, your margins might not go up because you'll have to cut prices to keep up with them. So competition matters. It's great to have economies of scale and great unit economics in a market where you don't have much competition. A market with competition, you know who's going to walk away with the benefits? You and I as consumers, because it's going to get passed through. On the question of when will I get there? You know what I mean by when will I get there? I'm at 3%. I think I can get to 25%. The numbers in a spreadsheet. So can I get there in year 2? You'd rather get there earlier rather than later, right? But to make that judgment, you have to first start with your current number. If your current number is minus 55%, my guess is you're not getting to plus 25% in 2 years. There's a lot of work to do. The second is what the business model for this company is. Is it focused on growth or is it focused on actually becoming profitable? Your worst case scenario is you invest in a young growth company, but the management has completely forgotten about the fact that they need to make money. All they do is scale up and get scaled up again. I valued Paytm when they went public. The biggest mistake I made was I thought they were run by rational people. What was Paytm's biggest sales pitch when they went public? What was the most impressive number about Paytm? 330 million people on their platform. That's the advantage Indian and Chinese companies start off with, right? 330 million people. Oh my God, I will never get there. No European payment platform will get to 330 million because that will require every person in Europe, including the childs and pets, to be listed on the platform. That was the most impressive thing. But if you're a payment processor, remind me again how you make money. When people transact on your platform, you keep a slice of it. It's called the take rate. Right? This is not something that technology created. Credit card companies, this is basically. So if you look at it, if you use an American Express at a restaurant, you transact. How much goes to American Express? It's the highest percentage of any credit cards, 3.5% to 4%, which is one reason a lot of merchants don't take American Express. Right? Then you go to MasterCard, one of the great franchises of all time. If you see a company that's actually been able to keep the competition away and still manage to grow, MasterCard is it. They make about 2.5%, but it's huge gross transaction value. PayPal is about 2 to 2.5% as well. You know what Paytm's take rate was when they went public? 0.3%. Why? Because they were giving away free. I made the mistake of actually putting the Paytm app on my phone because I wanted to see what it was. I had to take it off very quickly because they kept sending me free offers every day. More free stuff for you, more free. I don't want free stuff. But you can see how they get people on the platform. I'll give you free stuff. If Starbucks gave free lattes, would they sell a lot of lattes? Yeah. That's a terrible business model. I assume that now there are 330 million people that the management of Paytm would turn their attention towards improving the take rate. And there are two things I underestimate. One is the capacity of management to stay in denial. Because the Paytm management seems to have absolutely no idea that profitability is a part of a business model. So you know what they did when they had 330 million? They wanted to go to 400 million. They did not stop sending more free stuff to me. And this is the second problem, and this I should have factored in more carefully when I did my valuation. Alipay has a take rate of 1.5, 1.6%. It's lower in Asia than in Europe. But India has a particular problem if you're a payment processing company. There is a free payment processing service in India, UPI, which a lot of people can use. So you're competing against somebody. It's a government structured payment processing system. It's not going to be completely good for a shopkeeper, right? It's designed for, for really small businesses, but it's there, which effectively means it'll act as an anchor pulling down the take rate. My guess is in steady state, Paytm is going to be lucky to have a 1.2, even if they do things right. The way they run, they'll never do things right. So when you assess this, not only are you looking at the business model and what the company is doing, you're looking at how focused the management is on actually delivering profits. The day I was willing to look at Uber as an investment was the day in 2019 when Dara Khosrowsky would just come in as CEO to replace Travis Kalanick, would leave in a whole host of scandal. He got in front of the Uber employees and he said, hey guys, we need to figure out a way to make money. And I dropped to my knees and said, thank you, God. Finally, after 12 years of scaling up and billions of dollars of capital, you finally woke up to that realization. And you can actually argue that Uber's been run differently. They're trying. There's Uber One where you can actually get a membership. They're trying to make the model more sticky. And that's all you can do. Uber's in my portfolio, it's in Bill Ackman's portfolio. I think part of it is they are finally figuring out it's not adding another city that I want you to do. I want to take your existing cities, maybe shed some of the cities you're in. Maybe they're not worthy of being in, and think about ways of making money. So all of those things feed into your margins. So yes,
So I'm thinking about the payment companies like in Europe, there are many players that they are just hooked up.
most of them will not live, right? Because right now, all they're doing is scaling up, going to venture capitalists, raising more capital. Say, I'm bigger than I was before. You have to, I mean, the blame here has to go to venture capitalists who funnel money to businesses, encourage them to scale up, and never stop and ask the question, what business model are you in? If I'm a founder, I'm a tech person, I need somebody helping me on the business model side, right? But these VCs, it's almost like they're drug dealers feeding you more drugs. Scale up, scale up, scale up. And in fact, you need addiction treatment programs. And you say, okay, we've scaled up enough. Now come back to this program so we can talk about making money. It's a different mindset, right? Every day you wake up, how do I get more users? How do I get more subscribers? And I'll safely predict that at the end of the game, this is a consolidated business. There are going to be 2 or 3 players no matter where you are. There's a reason credit card companies consolidated the way they did. Right? If you had 50 different credit cards, think of how much trouble shopkeepers have figuring out, you pull out a credit card, you've never seen it before, whether in fact they can trust the credit card. It's a business going to consolidate. And Europe being Europe, I'm not sure when that cleaning up process will be, but there will be a
It's
cleaning
like
up
there are
process.
few players that they are keeping like growing up.
But ultimately they have to grow up. They have to go through what I call the bar mitzvah moment, right? If you're Jewish, bar mitzvah moment. These companies need to grow up. They need to say, look, it's not like you grow up overnight right after your bar mitzvah, but it's a ceremony. You say, hey, you know what? You're growing up. You need to think about more than what your after school specials look like. And I think these companies need that bar mitzvah, take that moment more serious. So with the Airbnb in November 2020, here's what my numbers look like. I projected that when they were in steady state, the gross bookings, ultimately Airbnb makes money when you book something, gross bookings would be $155 billion. You know what Marriott's revenues were last year? 25 billion. So Airbnb will have 6 times more. And the reason I feel pretty comfortable is you look at bookings.com or Expedia, they have big numbers because it's a consolidated business. So that's how I get the revenues. For the margins in steady state, I gave them 25% margins. You think you're making that up? I might have. But here again, I look not at hotel businesses, very different business model. I was lucky I had 2 publicly traded companies, Expedia and Booking.com out there. Booking.com at 30% margins, Expedia at 8 to 12% margins. You know why? I was surprised. Expedia actually has a segment of the business model where they buy hotel rooms from hotels. They keep it in inventory and then they try to sell them at a higher price. It's a different business model, not a better or worse. It's a different one that's pulling the margins down. Airbnb is never going to buy your apartment for you, pay you up front and keep it. So I don't think they will enter the Expedia model. There's a story there I'm telling about Airbnb, but it reflects the business or businesses I think they're in. Revenue growth margins. Any questions about the margins part of your story? So what kind of margins are you going to give on? What are you aspiring to be? First, they're making money already, right? So what are their margins right now? So they're already pretty solid, right? Nike's margins are pretty close, right? So there might not be much room on the margins. You're hoping and praying you can hold on to your margins. So almost all of their increase has to come from revenue scaling up. And if they introduce a cheaper chute to be able to get even more in revenues, you got to build that into your margin story, saying, I will now be able to double my growth rate, but margins will go to 12% from 15%. Third and final input, and this is the one that gives me the most trouble because it's the most shaky number. It's a number where I'm asking for every dollar of capital I invest, how many dollars of revenues can I get? The higher that number, the more efficiently I'm delivering growth. So when I look at the things that go into it, I'll obviously start with what your history tells me about you. So in fact, for Airbnb, I looked every year at the change in sales and the change in invested capital. The number was like $1.5 of revenue. I was surprised how low it was because I was told this is a low capital intensity business, but it turns out they have to do acquisitions. And this is the thing to remember about a lot of technology companies that claim to be low capital intensity. They don't build factories, they don't have fixed assets, but they have to do acquisitions just to keep going. Airbnb has done like 25 acquisitions over their lifetime of technologies, sub-platforms. So they got about 1 point. So I'm going to look at that. If I can, I'm going to look at the business as well. But there are three things about this company I'm going to look at. One is, as they get bigger, is it going to get more easier for them to scale, that sales to capital, will it go up or not? In some businesses, it might. You could argue that as you get bigger, you can be more efficiently start to deliver revenues because you're drawing on your existing infrastructure. If your company is in one of those businesses, you can increase the sales to capital ratio over time. Most companies, though, you'd be surprised how quickly you hit a ceiling. Okay? So don't take your sales to capital ratio of 2 and make it 17 just because you feel like it. It's very difficult to pull that off. But once in a while, you will be able, in your company, to be able to scale up with very little invested capital. I talked a little bit about Boeing in the last session, right? So if you're valuing Boeing, you're catching it at a really bad time in its history. They sold fewer aircraft last year than in decades. Why? Multiple factors. Let's say you map out a pathway back to grace for Boeing, where their growth is coming from not just increasing aircraft to some high number, but going back to pre-2000, pre-737 MAX levels. You put in a 20% growth rate, which will in about 5 years get them. Do you need any reinvestment? Relatively little. Why? Because their existing, if you look at their assembly lines and plants, they're more than 50% excess capacity. This will actually be using the excess capacity. You might have to retool. So if you give me a really high sales to capital ratio for the next 5 years, I'm going to step back and say, you know what, that makes sense. This is something I run into with Tesla. With each new factory they build, right after they build a factory, they get about a 3 or 4 year window where they can grow with relatively little reinvestment. So when they only had the Fremont plant, I had to think about new plants. Now they have a plant every 2 or 3 years. You get this window where you can grow, and it's a limited window, it's not forever, where you can give them a high sales to capital ratio. Yes. Reinvestment is all of it. So don't ever break it down. Reinvestment is all net capex, change in working capital. So if you have a very high working capital driven business, it just means you'll have no scaling up effects. As you grow it, everything has to grow with it. So it's captured all in that number, right? So my reinvestment is everything. Acquisitions, net capex, change in working capital. So look at your business model and see what drives it. Maybe for on, it's a working capital. That's a big part of invested capital. Worst part about that, it's very difficult to break out of that cycle, right? As you grow, your invested capital has to grow with it. And finally, there are some businesses where there's a lag between when you reinvest and when you grow. Let's take Novo Nordisk, fastest growing large pharma company right now. Driven by what? Ozempic and Wegovy. When did they do the R&D for Ozempic and Wegovy? Decade ago for a diabetes drug, right? This is purely providential. It turned out that you lost weight. If you're valuing a pharma company, you see what this is going to mean, right? The sales to capital ratio will not be based on the change in revenues this year. It'll be the change in revenues 10 years from now. And even 10 years from now, your company is going to be a mature company. You can live off past fat for a while. And if you look at why Eli Lilly's priced the way it is, because they've been successful with the obesity drugs, they've done the hard work already. So you can give them a high sales to capital ratio, low reinvestment, and still give them high growth rates. So in the case of Airbnb, I did give them a sales to capital ratio of 2, roughly where they are, because I don't see a scaling benefit here that's going to kick in on the reinvestment side. What does that mean? I take the change in revenues each year of just their revenues, not the gross bookings, and I divide by 2 and I'm done. That's my reinvestment each year. The end result is you look at my free cash flows of firm. This is in my upbeat, optimistic story. There are my free cash flows in the next 6 years, negative, negative, negative. Eventually, the numbers turn. You need that for value. Is this a pessimistic view? It's an incredibly optimistic view. But because I'm so optimistic, the cash flows are actually more negative. Gabriel?
Like in case of the pharmaceutical company, how do you factor the regulation?
The pricing, right? Right? Because once you've developed a drug, you got to sell it. The reason US pharmaceutical business is so much more valuable than the pharmaceutical business elsewhere in the world is not demand, right? There are far more need, there's far higher need for insulin in India because there are more people on the face of the earth. But in India, I think an insulin dose could cost you $2 to $3. Here, even with the price caps, it was like 38, 40. This is a business where there's pricing power, which we all complain about in healthcare because it is the cost to us. And that pricing power is what keeps these companies valuable. So you show it as higher margins for a company which has pricing power than for a company that doesn't. That's why niche pharma companies can end up with really high margins because and it sounds morbid, but you're going after a small portion of the population. You can charge outlandish prices and get away with it. No. I'm not talking Martin Shkreli business model. And if you have no idea what I'm talking about, type in Martin Shkreli into Google and you'll find out. But I'm talking even legitimate pharma businesses are built on pricing power. In fact, one more thing, as you reinvest, something we don't think about, reinvestment is actually a delta in invested capital. So you can actually track what you're doing to your invested capital over time. And because your after-tax operating income is coming from your revenue growth and margins, you can compute what I call an imputed return on capital. You're saying, what am I going to do with it? You're building a company in your spreadsheet here, right? You got to ask yourself, can I live with the company I've created? This kind of gives you a sanity check. That's why in the Excel spreadsheet I send you, I compute your imputed return on capital over time. If you get a 5,000% return on capital in year 10, there's a message in your spreadsheet. What's the message you're getting? You're not reinvesting enough. How do you fix it? Go lower your sales to capital ratio. There's feedback loops in your spreadsheet that if you're listening to, you can make your valuation much more robust. One final point, whenever we talk about return on capital or sales to capital or whatever other number you do in valuation, you're talking about marginal numbers. You know what I mean by that? It's what you will earn on your new projects, not what you've historically earned. The only problem is all our data is based on aggregated data for the whole company. And that can sometimes be deceptive. And here's why. Let's say you have a company with a 25% return on capital. That's total after-tax operating income divided by total invested capital, right? But if I looked at what they actually took last year as projects, is it possible they earned a return on capital well below 25%? Absolutely. And what's hiding it? The fact that you have this great and glorious history. Coca-Cola could take terrible investments for the next 5, 6, 7 years. You wouldn't even notice it till you get to year 6 or 7 because they have such a legacy return on capital to build on. So when you think about marginal returns, there's a way to compute it, but it's incredibly noisy. I actually report in that in the Ginzu spreadsheet that take the change in revenue and change in invested capital. It's all over the place. But there might be a pattern if you can compute it over time to see if your company is moving away from or towards its historical return on capital. Brings me to the last piece of the puzzle. First, let's be clear. Why do we need a terminal value to get closure? We can't estimate cash flows forever. So if your cash flows are in perpetuity, saying, what do I do? You stop in year 5 or 10, you estimate a terminal value. Right? And if you accept that that's why we have it, then the question becomes, how exactly do you get there? So let me lay out the 4 approaches, including the one I said should not be done. The first 3 are all intrinsic value approaches. They're perfectly compatible. You can do liquidation value. How would you get the liquidation value of a company? What would you do? Any idea? Look at what they own, and if it's land and building and equipment, you got lucky. Land and building, especially, it's real estate. If it's patents, you got a little messier analysis, but liquidation values, think of it as eBay. Basically, you're taking your company, you're putting every asset in eBay and getting the best price you can. Liquidation value for finite life companies, of companies where there's a personal component to the business, where when that person passes on, the business dies. Liquidation value works good. For going concern, you can either have the perpetuity, which is what we tend to see in most textbooks, including mine, or and I think we need to emphasize, I need to emphasize this more in my textbooks, that you can compute terminal value by assuming that you get to your 10, and then you have 20 more years of cash flows because your technology is going to die after 20 years. It's a present value problem. And as I mentioned, the one way you cannot do this is to take your terminal year, whatever number, revenue, EBITDA, EBIT. And the reason is not that it's a bad thing or a good thing. It makes your biggest intrinsic value number into a pricing. You have a forward pricing, and you create the charade, the front end of cash flows. So I'm going to put in a series of guardrails on intrinsic value calculations that hopefully, if you follow, you will not get into those side alleys that analysts often get into. First, let's stay with the perpetual growth model. Cash flow in the next period divided by R minus G, right? So you get to year 10, you get the cash flow in year 11. It always has to be one year after. Why is that? It's a present value rule. Present value needs next year's cash flow, not this year. So it's not specific to terminal value. It's any kind of present value equation. The first cash flow is to be 1 year from now. So to get the year 10 terminal value, you need year 11's cash flow divided by R minus C. Take a look at the denominator, because that's the most dangerous place in valuation, right? R minus G. And if I let you play with the G, you're going to get your terminal value to whatever number you want. But this is a growth rate you're going to be able to maintain in perpetuity. Let me set some rules on the table. You tell me whether you agree with them. This growth rate cannot exceed the growth rate of the economy in Europe. It's a math issue, right? This is not a finance rule. It's not an economics rule. You can't let one number grow at a higher rate than the other number, because that first number is going to become larger than the second number. Your company will become the economy. Should it be in nominal terms or real terms? You'd be surprised how often I get asked this question. When I get to stable growth, should I use a real growth rate forever or a nominal growth rate? What's the answer to that? Ask them what they've done for the first 10 years. Because by the time you got to year 10, you did something for the first 10 years, right? Did you do nominal cash flows? If you did nominal, you got to stay with nominal. If you did real cash flows, you do real. What currency? Well, you chose again, right? You did your cash flows in dollars for the first 10 years. Don't switch to euro growth rates. It's got to be in the same currency. So it's a consistency issue. Now, of course, I've replaced one problem with another one, right? Because now value a company, what do you have to do? Project out what the growth rate will be in the global economy in US dollar terms after 2035. Good luck on that one. You know how much time analysts spend on trying to get this number finessed? What's the right answer? If in fact you go down this, there's zero chance you can reason your way to a number. So I'm going to use a shortcut that works for me. You're welcome to use it. You're welcome to abandon it. And I'll tell you why I use it. When I get to year 5 or year 10, my cash flows, and I want to put my company to stable growth rate, I put a cap on that growth rate. And my cap is my risk-free rate. Remember, this valuation has a risk-free rate in the denominator. Let me explain my justification for this. I don't know whether any of you remember this equation called the Fisher equation. I saw it in my econ class way back in time. Okay. Fisher equation is actually very simple. It says a nominal interest rate is composed of two numbers, an expected inflation rate and an expected real interest rate. What's a nominal growth rate in the economy? Expected inflation rate plus an expected real growth rate, right? Set the equations next to each other. The expected inflations cancel out. The question becomes, what is the relationship between real interest rates and real growth rates? I'll tell you how I would start real interest rates in my econ class. My professor kept talking about apples. He said, if we borrow 100 apples today, you got to return 102 apples a year from now. You know why, when you talk about real interest rates, you have to talk in terms of goods and services rather than dollars? Is you're borrowing something today, you're returning it a year from now. A real interest rate is in terms of real goods and services. And that actually is going to allow me to break this deadlock. Let's say I go around promising people a 3% real interest rate, but my economy is growing in real terms by only 2%. I'm going to have a problem. You see what it is? Where the heck am I going to make up that extra 1%? So your real interest rate cannot be greater than the real growth rate in the long term, because things are going to blow up. The other side is a little more difficult to prove. Can a real interest rate be less than the real growth rate for extended periods? But eventually, the real interest rate will start creeping up because there's so much room in the economy to make great investments. People will start to desire to consume more now. So either direction, there's convergence between the two numbers. And when you get to the terminal value, you don't need this to happen next year, 2 years from now, but eventually it's going to happen. You're not convinced, I can tell, so I'm going to try a second ploy. We want a nominal growth rate in the economy, right? So here's the experiment I ran. I went back in time to 1954, looked up the T-bond rate at the start of each year, looked at the nominal growth rate in the next 10 years. I was trying to figure out, is the T-bond rate a good predictor of nominal growth? And for the last 50 years, I was able to run a contest of the T-bond rate versus the consensus growth rate you got from the 50 top economists in the US. This is no contest. You know which metric won out continuously over the T-bond rate was a far better predictor of nominal growth rate in the economy than the 50 top economists in the country with all of their tools and their models. And I'm not surprised. Here's the problem when you get forecasting from economists or market timers. There's no money behind it. I can get on CNBC saying, I think the economy will grow at 6% a year. What if I'm wrong? Doesn't really matter. I'm not going. When you're in the bond market, I'm asking you to put money behind your backing. And the T-bond rate is backed up by trillions of dollars of money. So I'm not surprised that T-bond rates are better predictors of nominal growth. So if you don't buy into the Fisher equation argument, maybe the empirical argument does pretty well in terms of, and that's actually terrible news if you're in an economy with negative interest rates, right? Because what is the bond market sending as a message? Deflation and negative growth. And that's basically more likely to be true than not if the history holds out. If you're not convinced by that either, I have a third argument for why the risk-free rate is a good proxy. Valuation is all about being consistent. You get to your year 10 or year 11, you estimate a risk-free rate. You also estimate a growth rate in perpetuity, right? Could it be, is it possible that interest rates are too low? Yeah, it could be. But if interest rates are too low, you know what you do? You also keep growth rates low. And if you're wrong in the same direction in both, it cancels out. If interest rates are too high, again, not a problem. My discount rate will be too high, but I'll give you a higher growth rate. It keeps your valuation from going off the rails. This was the big issue in the last decade, because as you know, at least 3 or 4 currencies had negative risk-free rates. Euro, the Swiss franc, the Japanese yen, and it freaked people out. And here's the reasoning. They said if risk-free rates turn negative, my valuations are going to become really, really high. Do you see the reason for that, right? Risk-free rates become negative, you have a low cost of capital. And if I use the growth rates I've historically been using, 2, 3, 4%, my valuations are blowing up. And that constantly push, and they would try to normalize risk-free rates and do neat things with it. So there's an easier fix here. And I'll show you what the fix is by showing a valuation I did of Heineken in September of 2019. I did this in Munich, and there were 3 people in the audience from the Heineken finance group. So initially, when I went through the cost of capital, they were actually very happy that I left the risk-free rate where it was, minus 0.5%. Why? Because it gave them a cost of capital of about 5%. You know, patting each other back, saying, this is a great world we live in. Then I got to the numerator, and I had to estimate growth. And remember, what's the message I'm getting from the negative risk-free rate? You're living in a deflationary, low-growth economy. So I gave them a low growth rate, 3% a year. They were a little disappointed. But what I did on the terminal value freaked them out. When I got to the terminal value, take a look at the growth rate I've assumed in perpetuity. I'm following this through. Capital the risk-free rate, I gave them a minus 0.5. And they said, this is not fair. I said, you weren't complaining when I gave you a really low cost of capital, right? What one hand gives you, the other hand takes away. In spite of risk-free rates being negative, Heineken came out as overvalued. So it cuts against the grain of low risk-free rates are good because the cash flows are actually worse affected than the discount rate by this phenomenon. So as long as you connect your risk-free rates to your growth rates, what got people into trouble in the last decade is they continue to use growth rates in the terminal value based on what they'd learned in school in the 1990s or what they learned in their jobs in the previous decade, while lowering the risk-free rate to what it was in 2017, 18, 19, 20. That's a mismatch that can cause your terminal value to explode. Yes, Jacob.
So like in the US currently, the 10-year T-bonds at 4.5%. So you're
And
saying
you
you could put a
put the-
4.5%.
That's your cap. It doesn't have to be that your growth rate is at 4.5%, right? That's your cap. You can give any number lower, but you can't go above 4.5%. You're saying, what if it's just a little bit more? No, still not, right? You still need to give away the cap. So obviously, you get a lot more room on your stable growth rate now than you did 3 years ago when rates were 1.5%. But it also comes with the catch, right? You now have a much higher discount rate you're going to be using for that terminal value and a much higher discount rate to bring the terminal value back. Net, are you better off or worse off? I'm not sure. Right? So it kind of cuts both ways. And that's the way it should be. It's kind of compensating effects in your cash flows and your discount rates. So you're valuing on. One of the questions you're going to face is, when will my company be a mature company? And On has 800 million in revenues. The business is huge. It's well regarded now. And you're saying, can I give it a 25-year growth period? Can I give a 20-year growth? And often with companies that are star companies, young companies, you say, why can't I give it 15, 20, 25 years? Okay. So here are a couple of things to keep in mind as to how long you can let your company grow before things start to mature. First is, if you're a small company in a very large market, clearly you have more room to wait longer till you make your company mature. On can grow for a long time, not end up dominating the market. But also remember, growth creates value only if you earn more than your cost of capital. So the other half of this picture you're asking is not just whether I can grow, but whether I can earn a return that exceeds my cost of capital. And that is tied to what kind of sustainable advantages you have as a company. We'll talk more and more about storytelling for your company, but part of your story has to be about what happens after year 10. Does your company become a commoditized company, earning its cost of capital, or is it a company like Coca-Cola or Amgen that might have competitive advantage that spill over forever? Because that's going to determine whether you can keep the return on capital above the cost of capital. So as you think about, how long, don't wait too long. Most companies mature far faster than you think. So about 30 or 40 years ago, I started collecting data on growth companies. I've never updated, I'm too lazy. And I just chronicled how long growth lasted at a typical US growth company. 3 to 5 years before you kind of become very much like the industry. You see, but there are companies out there that have grown for more than 5 years. Absolutely. And we can name any of these companies that have grown for long periods, which tells you a lot about the exception, not the rule. Third, remember that when you put in a growth rate or change the growth rate terminal value, something has to change in the numerator. And to show you the effect of this, I took that example we started with. Remember $100 million after-tax operating 10% cost of capital? And I said, what if the growth rate is 2%? With a growth rate of 2%, you know what the value would be? $1 billion if the return on capital is equal to the cost of capital. Could it be higher than $1 billion? Not because the growth is high, but because you earn more than the cost of capital. If you're a bad business and I put in a 2% growth rate in your terminal value calculation, I will demolish your terminal value each time I raise the growth rate, because what you will lose in the numerator will be far greater than what you gain in the denominator. So when analysts push back and say this growth assumption, my terminal value is making a huge effect on value, they're already confessing to what they're doing, right? What are they doing? They're taking the terminal value, keeping everything in it fixed, and taking the growth rate from 1 to 2 to 2.5 to 3. Of course, your value is exploding because you're creating growth magic. You're putting in a growth rate without telling me what happens to your cash flows. Now, my valuation book was published in 1980. My very first valuation book came out in the late 1980s, perhaps 1990, around the same time that McKinsey's valuation book also came out. And they were both published by John Wiley. And the McKinsey valuation book, you get to the terminal value chapter. The terminal value, at least in the original version of the book, was no plat, which is just EBIT times 1 minus T. They invented this word no plat for it, divided by cost of capital. There was no growth in the equation. For years, I would get emails from people reading the McKinsey book saying, I'm reading the terminal value chapter. I notice there is no growth in the terminal value. Why? To which my response is, why aren't you writing to McKinsey? Why are you writing to me? But we both published, they thought I probably hung out at a bar with the McKinsey guys and we chatted about terminal value all day. Hugely depressing thought if you think about it. You know? But the reason was actually in the book. What McKinsey assumed is once you get to stable growth, you earn your cost of capital. And the reasoning is in the long term, no company earns more than its cost of capital. Therefore, you get to year 10, we're going to make the return. And if you make the return on capital equal to the cost of capital, what do we say about growth? It doesn't matter. So might as well use a zero growth rate. But McKinsey in its own research came up with data that countered the assumption they were making in the valuation book. The publication from McKinsey called McKinsey Quarterly. It's a great publication. It's free. It's of lower quality than it used to be because it does a lot of crappy stuff in the middle. But they have lots of data, proprietary data from their clients that they look at to answer questions. So one of the questions they were looking at is, if you track companies over time, what happens to the growth rate? No surprise, as you track them, the growth rate starts to move towards the growth rate of the economy, which is what we assume. Then they ask the question, as you track companies over time, what happens to return on capital? And notice the return on capital doesn't drop to the cost of capital. In the real world, there are quite a few companies out there that earn well above the cost of capital and will continue to do so for decades. Partly because of existing investments that are not going to become neutral investments at the end of year 10. I don't like the McKinsey assumption of return on capital is equal to cost of capital for every mature company because it takes away a degree of freedom I want to maintain in my story. When I value Coca-Cola, I want to give Coca-Cola. This is the only way I can reward great companies when I get to year 10, right? I can't let them grow at a rate faster than the economy, but I can give them returns on capital that are in excess of the cost of capital. But that has to then become part of my story. What is it about this company that will give it long, sustainable advantages? I don't know how many of you worked in private company appraisal or even public companies. I'm going to give you a collection of assumptions that you will see all the time in real world valuation. So you'll have an analyst projecting cash flow the next 10 years. At the end of year 10, they'll tell you their company is a mature company. So far, so good, right? They'll say it grows at 2% a year. Is that okay right now? Yeah, 4.7% is the cap, 2% is fine. And then they would say, because it's a mature company, I am going to assume, I being the analyst, I'm going to assume that CapEx offsets depreciation. What does that make net CapEx? Zero. And working capital requirements are negligible, which makes a change in working capital zero. What's 0 plus 0? 0. What's 0 divided by any number? 0. So the reinvestment rate is 0. You see these are valuation models that are built to blow up. What's the inconsistency? You've assumed a 0 reinvestment rate and you're telling me, and of course the pushback you get is, what if I set it at the inflation rate? Sounds alluring, right? Because you don't need excess capacity. What's the problem with even if it's just the inflation rate? No, you can't make it the cost of capital. It's got to be a reinvestment rate. What is reinvestment? When you say the CapEx offset depreciation, what are you doing? You're replacing old machines with new machines. You're not building new capacity, right? And if you have inflation helping you on the revenues, guess what? It doesn't go away when you replace the old machine. You say, look, you know what? The inflation is only for my revenue stuff. No, your same machine will cost you more, which effectively means even if you grow just at the inflation rate, this reinvestment assumption will still kick in. There's no escape hatch here. If anybody tells you they can have 0 reinvestment and grow, that's valuation malpractice. There is no justification for it, but people do it all the time. So now you have the ammunition. The next time you run into this combination, about half of all DCFs I see have this combination and they're able to get away with it. No, pushback. Finally, what are you doing to your company? You're making it a mature company, right? What does that mean? You're bringing your growth rate down. That's the bad news. But is there any good news to being middle-aged? You see. First, you have more wealth, so you're more stable, right? which your cost of capital will show up as a cost of capital decreasing. You also can probably have a more settled set of return on capital. So so what I'm trying to say is if you make your growth rate, when you make your company a mature company, not just the growth rate that changes, your cost of capital should start to move towards the cost of capital of a typical company. Okay? That's why I do that histogram of cost of capital, median cost of capital 9. So as I look at year 10, I'm trying to push your company towards a median. Okay? Will your return on capital probably decrease as you get? Probably. You're a great company, you're going to become less great. Doesn't mean your cost, you get to the cost of capital. But if you're earning a 30% return on capital now, I can almost guarantee that if you scale up fivefold, that return on capital is going to come under pressure. You're going to move it towards the cost of capital. And because your growth rate is much lower, you can't, this is exactly why you can't take your year 10 cash flow and put a 1 plus G on it to get to your cash flow near 11. You're looking at me like, that's what I was planning to do. What's the problem with taking your 10 cash flow and putting a 1 plus G on it? You're taking the reinvestment rate you had in year 10 and essentially locking it in for perpetuity, right? So let's say your growth rate in year 10 is 5%, and beyond year 10, it's going to be 2%. You need to recompute your reinvestment rate for your terminal value calculation because your year 10 number will give you too low a cash flow. Give your company the characteristics of a mature company. And if you do that, effectively, it's going to play out. Last piece, and this is just a kind of wrapping up piece. Lots of talked about lots of different ways you can value your company, right? Let's look at the choices. You can, at this stage, you got cash flows, you got growth rate, cost of equity, but you're saying, which cash flow should I discount? Dividends, free cash or equity, free cash for the firm. Which discount rate should we use? Cost of equity, cost of capital. What kind of growth pattern should I add? When I think about valuation, I think of 3 big boxes of Lego that you're trying to put together to get different discounted cash flow models. So let's start with the first block. Which cash flow should I discount? For firms which have stable leverage, you're probably better off using equity because you can do the shortcut to get to free cash flow equity. Which means for most of you, what do I mean by stable leverage? You have a debt ratio today and you think your company is going to stay at that debt ratio in perpetuity. You do Con Ed, yeah, probably stuck in the ways. You do on and you put in the debt ratio today, make it the debt ratio forever, you're probably going to be in trouble, right? So when you get, and for financial service firms, and we'll talk about why you end up with equity valuation alone for financial service firms. For everybody else, it's better off valuing the entire firm. So let's say you come to this fork in the road, you've decided to go the equity valuation route. There are 2 cash flows you can discount in equity, right? You can use the dividend discount model or the free cash flow equity model. So which one should I pick?
Dividend somebody else. If the dividend payment pattern is not stable, we go for the.
If it's stable, you're going to take the dividends. You're going to walk right into a trap there, right? Because every dividends are always stable. Why are they stable? Because they're sticky, right? It's not that whether they're stable, but whether they reflect my free cash flow equity. If a company pays out roughly what it can afford to, which also means then might as well use a free cash flow equity model, right? Unless you cannot estimate free cash flow equity. You say, why would I not be able to do it? I've taken this class. Remind me again what I need for free cash flow equity. I need net income and add depreciation, subtract CapEx, subtract change in working capital, and subtract change in debt. I'll give you an assignment. Take any bank, and I challenge you to estimate the free cash flow equity for a bank. Net income you can get, right? But everything below it, I have no idea. What's amortization for a bank? What's CapEx for a bank? What's working capital for a bank? What's debt issuances and debt repayments for a bank? So for as long as we've been doing valuation, people give up on banks. They say, I can't estimate free cash flow equity. So what are you left with? Desperation. You do the dividend discount model because you've given up. And I'll make a confession, until 2008, that's what I did. I no longer do it because I think we can dig ourselves into a hole when we use the dividend discount model. But that's why we use dividends. It's not because we think they're somehow better for banks, but because we can't estimate free cash flow. So second fork in the road, equity value, free cash flow equity. If you can estimate free cash flow equity, just stay with the free cash flow equity model. What discount rate should I use? Well, I've already chosen the cash flow, right? The discount rate is really not even a choice. You pick the cash flows to be cash flows to equity, your discount rate has to be cost of equity. Remember, Kennecott and First Boston. Cash flow to the firm, cost of capital. What currency? Again, tell me what currency you did the cash flows in. So the discount rate choice is out of your hands once you made the cash flow choice. And final piece, can I get away using a stable growth model? Can you? What kinds of companies, some of you might have picked these companies. What are you going to check to see if you can use? Because a stable growth model means you don't need the front end of 10 years of cash flows. You can just go right now and get cash flow next year, R minus G. You can be done with your DCF valuation in 5 minutes. You think I'm tempted. I'm going to take my company. Yeah. First, it has to be a stable growth company. And so what are you going to check? The growth rate to see if it's less than the risk-free rate, right? There are a few hundred companies in the US, but that's good. Second stop, you got to look to see if it's behaving like a stable growth company. In what sense? If this company is reinvesting a lot, no matter what the growth rate, it thinks it can have higher growth rate, that gets in the way. Your margins have to, everything has to have settled in. I'll say 1 in 25 companies I look at, stable growth company, I can just go directly to the terminal value equation. Cornet, I'm going to value later on in the class with a stable growth model. But if you have any growth that's still residual there, for even mature companies have some growth. Levi Strauss is a mature company, but it has potential growth in Asia. Asians don't wear jeans as much as the rest of the world. Maybe it can convince them. That could give you a little growth, but that's a 2-stage model. And if every other company, you need some kind of a transition. 2-stage models work fine if you have 7% growth for the next 5 years and you're going to make it 3%. But if you have 70% growth, going from 70 to 3, it's a little too much to ask. You create a transition. Ultimately, every discounted cash flow model you see out there. So when people talk about hundreds of DCF models, break it down. What's a cash flow? What's a discount rate? What's a growth pattern? Right? It's the same model playing out in different disguises. So I'm going to stop there. When we start on Monday, we're going to talk about the loose ends. You have everything you need to do your basic discounted cash flow valuations. I'll send you that Excel spreadsheet again, because as I said, I'd like you to use my spreadsheet, not because it's better, but this is the time to kind of, while the iron is still hot, basically, do your valuation, do a first round, and then you can always revisit.
So, John Pontier, some of our technical, simply just like $100 no debt.
Yeah, you're gonna learn.
Obviously, they're like still very much in the early stage. I would think that as they kind of mature, the capital structure will it's daily cash, yeah.
Because the market cap is huge.
Yeah.
You're never going to get that 50%
Yeah.
The second is with that. Why are you doing it?
Yeah.
So I think the cost of capital will increase, but rather than go all the way to the 50% time,
So then how about for doing a one half goes to equity instead of not really that. Free cash flow firm and then allow it to.
That way you preserve the leeway of adjusting the cost of capital. Just because you don't have debt, meaning you're lost.
Falling off.
If it's a free cash flow to the firm, it happens to be there. So it's not.
Hey, take care, man.
So we preserve the option to change it at the same time. This is
And then as far as
Just because I have.
your discount rate,
You that's.
when you're in stage is 2, stage 1. Are you doing
But yeah, I think after-
in that discount
after the
rate
next,
during
like-
stage two or any? Obviously, the growth rate's
What
gonna
I do
It'll
is I
be
think
on-
about growth of cost of capital. I think the cost of capital should everybody. So I would actually go less than your 6, 7, 10.
Yeah.
Not worth the connecting of that number.
So it's just like.
Something like that for the big hours starting in the end. So come up with the starting cost of capital for the first 5 years,
It's amazing.
and then come
Yeah,
up with
but
the cost
also
of
like-
capital and up to your cash. And I take care of the difference.
It's true.
Just for clarifying for DDM. So the DDM is only used for the dividend effectively.
Extremely uninvited.
And if it's not, then go for either free cash flow reserve or free cash flow dividend.
So right, the only
If
time.
the leverage is stable, right? I mean,
People
for
leverage is same, leverage is not stable, neither free cash flow equity market.
Sure, it's like worth the.
Leverage is unstable, both numbers.
Now there's a lot of good for, they're like.
Oh,
Because
okay.
I can borrow money, pay dividends, right? I can use debt to pay dividends. If I have leverage shifting over time. Both numbers become on, equity valuation generally starts to fall apart. and that equation change.
Okay. But in your real life application, have you ever used the dividend discount model or only for banks? And on it is
Like a
it
separate-
perfect for dividend paying capacity.
Free cash flow. Long term, you just rub and hope and pray that it's roughly equal to free cash flow equity. I'll talk about a way to estimate free cash flow equity now for banks. But in 2008, remains.
Okay, and another question on the terminal free cash flow. I see, I mean, most of the time, like
What is
the bankers, they do this depreciation equal to capex in the terminal free cash flow. So your takes that
The only thing, when you use zero growth.
if okay, if you do that, it has to be zero growth rate because you haven't put in any.
Yeah, so like.
Right. And another thing is the quite common.
So like.
People use inflation rate as the
So like
terminal
today's
growth.
forty-
Oh,
So you have to replace old equipment with new.
You have to give up something.
And you have 3% inflation.
then
So
there's
it was
holiday,
really cost
so
you
you-
$1
there's
million
holiday
10 years ago.
Brazil,
Now gonna cost you $1
2 days before today.
You can't selectively use inflation to
And
push
since
up your
the
revenue.
weekend, and then the 2 days
They tell
before.
you that replace old machines with new machines.
Every stadium.
Because CapEx offsetting depreciation, that's
It's
an
fine.
old machine replacing a new machine, you're not adding capacity. But if there's inflation in the numerator, there should be inflation in that item as well.
So is he giving us?
so
There
it's
is
not,
no escape hatch. There's
it's
no-
not a good justification for all.
There's no justification.
Okay, so either to use wage free rate or the nominal
You could reinvest enough to do it.
Yeah, look at
But I
If
use
that's
growth
real.
rate enough reinvestment, or use no growth and no reinvestment, I can live with either.
I'll do that then, cause I.
I can't live with any middle solution.
So don't just say, I'm being conservative and using
You're
inflation.
not being conservative. You're
I
actually.
mean,
being
that's
aggressive,
what a lot of bankers say.
No, actually, when you